Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for the week ending on January 27th. My name is Ian Saunders, and we're joined as well by David Clark. Or I guess, David, I'm kind of joining you this week because I know that you were on it last week when we were kind of bouncing around a bit. So happy to be back on with you nonetheless.
Yeah, no, and last week it was a conversation when I kind of changed things up a little bit, talking about sectors, but we are now revisiting equities, and we're going to talk a little bit more about international equities today. So hopefully people aren't too tired of us talking about international just yet.
Not just yet. And I know you and I were just talking before hopping on here. There's, again, no shortage of stuff for us to talk about this week. I felt like that was a consistent theme throughout almost every podcast last week. And we actually accidentally called this year again 2022 instead of 2023. So hopefully we're a bit more straightforward and clear on the podcast today versus where the brains were heading into this. But one thing that is straightforward and clear certainly is the default chart of that S&P 500 index. And looking at the default chart of SPX, we're seeing clear and consistent movement higher over the course of the past few weeks, over the course of really this year so far. S&P's up over 4% through market movement on Wednesday, the 25th. And then today, we're getting a little bit of follow through the upside there, getting the S&P 500 to print another buy signal, a fourth consecutive buy signal on that default chart, up at a chart level of 40 rather, showing that real just kind of consistent, steady, stair-stepping movement higher. And we also, over the course of the past week, pushed back ahead of the 200-day moving average, is something we'll dive into a little bit more in just a bit. But I mean, long story short, we're just seeing signs of bullish confirmation from many of the indicators on the U.S. equity side and a lot as well on the international equity side, which we'll dive into. But on that U.S. equity side, I think one indicator, David, that you and I were looking at was that positive trend for the S&P 500, that PTSPX indicator. This indicator fell as low as 22% back in June of last year, which indicated that only 22% of stocks in the S&P 500 were trading in positive trends. Not a great sign for the domestic equity space, right? We ideally like to see 50% or more trading in positive trends. Well, we are above 50% now. We'd been above 50% since the fourth quarter of last year. We saw a level as high as 68% back in December, actually, pulled back a little bit. And now we're sitting up with movement this week. We reversed back up into a column of X's at 66%. So we're not only above 50%, we're back in a column of X's. It's a pretty solid sign for domestic equities, wouldn't you say?
It is. And it's almost like we're checking boxes right now that we haven't been able to check in prior rallies, which is a bit of a benefit when we look at some of these indicators that, at least we were able to make a higher bottom this time on that PTSPX rather than revisiting those prior lows like we've seen on the last two breakdowns. Somewhat of a silver lining, you might say, but now seeing that reversal back into X's for PTSPX, but another chart that I've seen and continue to monitor just because I like to look for a lot of the indicators to continue to show follow through. And one of the indicators that's almost a follow through indicator for the follow through indicators is going to be the multiple buy for NYSE. And it's measuring that percentage of stocks that are showing consecutive point and figure buy signals on their charts right now. And with this week's action, moved back into a column of X's that BPMB NYSE chart did at 22%. So suggesting roughly 1 out of every 5 stocks on the NYSE has been able to give consecutive point and figure buy signals. We saw this level last year when we saw a pretty good push through early December. We actually saw it rally up to 26%, but we really haven't been able to say really anything more than 1 out of every 4 stocks is giving consecutive buy signals since 2022. So now we're looking for that all elusive 30% mark at this point with this particular indicator. Still a little bit of a ways off, but this is the one that shows you that, okay, not only are you getting stocks, moving above their, whether it be their 200-day moving average back into a positive trend, back to a buy signal, whatever it may be, but this is the one where you're seeing confirmation that you're seeing further upside participation just by stocks being able to give consecutive buy signals. So helping out there in many ways, but where, like we've talked about too, many of the indicators have shown some positive action, and here recently, much like the S&P 500, it's been because they've been able to move above their 200-day moving average. So we've seen some action there too, right?
Yeah, certainly. I mean, I think on that buy signal one, though, one thing I was just kind of noticing and flipping back and forth between some of these indicator charts. I mean, you see 22%, that doesn't sound very good, right? I mean, that
No.
sounds pretty low when you're looking at it. But I mean, that's a chart that doesn't move around all that much. And as you touched on, I mean, that chart reversed higher in July, gave a buy signal in August of last year, turned around right back down and gave a sell signal just less than a month later, right? Then we got another climb back up, gave a buy signal in November, turned right back around and moved lower. This time didn't go back to that low. So that was a point that you brought up that kind of stuck with me there on that PT SPX chart, given that higher low. You see that on the
for folks. For perspective for folks, looking at the especially that multiple buy chart, like you said, it's not something that tends to get at very high levels, and something like 22% doesn't sound great. For perspective, looking back over 22, almost 23 years now, the chart's only ever been above 50% one time, and that was during the dot-com bubble days. So it's not one that you see with elevated levels all that very often, but is one that, provides that confirmation. And that's really what we're looking at with a lot of these indicators is, we see some positivity.
Seeing that confirmation and seeing, I mean, that indicator, even though it doesn't get that high, that confirmation is a good sign. One indicator that has gotten high, though, as you touched on, we saw the S&P go above that 200-day moving average over the course of the past week or so. And we've seen a lot of names underneath the hood within the broader domestic equities or global equities also move back above their kind of 200-day threshold. So one of the indicators that we use to track that is looking on the fund side of things. So not looking at the stock participation, but on that fund participation at 40-week for all equity funds. The ticker's carat 40MU0 for those that are following along. We'll also show the chart for those that are following along on YouTube. But this chart rose over the course of the past week. I believe right at the beginning of this week, got up to a chart level of 82%, which 82% for this, I mean, sounds high, right? But what is the 40-week looking at? It's just the percentage of equity funds that we track on the system that are trading above their 40-week or 200-day moving averages. So we're seeing over 80% of funds, of equity funds that we track on the system trading above that 200-day moving average. That's a good sign for fund participation. And actually the highest level we've seen for that indicator in over a year since you got to go back to November of 2021 to see the same kind of level. Then it was a level that was declining, starting to back off a little bit, but nonetheless over a year of lower participation readings from that more kind of classic 200-day moving average perspective. Good sign to see a lot of names kind of underneath the hood continuing that follow through to the upside. It's not just a few names that are moving things around there. We're seeing some good follow through from a lot of funds. And David, I know you were mentioning before we were hopping on here that a year ago, November is a kind of an interesting time to be related to from a fund scoring perspective.
It is, because if you actually roll over to the asset class group scores page right now and you take a look at just that non-US view, you're going to find a number of groups scoring above 3 within that non-US group, which is something really we've not been able to say in many cases in about a year or more. And for many of these groups, it's their first trip back above 3 or seeing that group score above that 3 threshold since really November, October 2021 is when a lot of those groups were improving back, summer, September of 2021. But we continue to see non-US groups, whether, at this point, it sort of started with Europe and we sort of talked about Latin America there for a while, but broadly speaking, as it stands today, there really aren't many areas that are faring better than cash, and there really aren't that many areas right now within that non-US view scoring below 3. It's probably the most we've seen scoring above 3 in, well, probably since that October, November timeframe back in 2021. If we really
about half of them, right?
Yep. At this point, so that, in addition to seeing money market and really, you were talking about it earlier, the only international or non-U.S. group related within the asset class group scores page right now that's below U.S. money market is frontier markets. Every other group has moved back above that U.S. money market group. And at this point, you've seen many of those notable kind of broader international groups move back above that score threshold of 3. And much so doing that since, like we talked about, since the latter half of 2021, as much of it has transpired since.
Yeah. And I think another kind of entry, you sort that non-US ranking by score direction. Only one area doesn't have a positive score direction, and that's India, which had been one of the kind of stronger scoring areas for a while on the non-US side. We've seen that strength back off a little bit from India, whereas other areas have kind of picked up strength. But only one group out of those broader kind of non-US focused classifications there showing a negative score direction. And like you said, only one area showing a score below that money market group, kind of that sub 2.5 score. A lot of breadth that we're seeing from the non-US side. And that's helped that US money market group really kind of get to back down into dampened territory, falling down to a reading of 17% with market movement there through Wednesday. That's some of the lower readings we've seen in quite a while there. You got to go back to the January. So again, about a year, you got to go back to the January timeframe in 2022 to see that money market percentile rank scoring at such a low field position.
Well, and it's like we've talked about, we folks may think we're quote unquote beating a dead horse when we're talking about non-US and international equity improvement and continuing to talk about it, but for the lack of something better to talk to truthfully or to talk about, it's something we continue to see. And that recent fall in the US money market group has been because of that non-US and that international improvement. I mean, yeah, you've seen some sectors do it as US equities have been able to rally, but it's been non-US that's been the primary driver behind a lot of that so-called US money market weakness, now developing some weakness relative to other things and really falling below that 100 spot ranking for the first time in probably 12 months, sitting around the score of 2.5, not really, many things within the non-US view scoring below that. And even if you look at US right now, there's been a decent number of them that have been able to pop back up, but that's developing into a picture where finally we're seeing global equities improve above cash and give investors some type of option there. And, two of the groups that I've continued to watch on and within this asset class group scores page, they're good sort of proxies for global, is going to be the all global and international to diversified group. And then today I was looking at it and comparing it to that all US equity diversified group because they're scoring so close, and was just curious, when was the last time they've scored this close? They were scoring pretty close about, you guessed it, 12 months ago. But really have to look back to that latter part of 2018 or even mid 2018, if I'm remembering right, that you saw all global and international diversified scoring above all US equity diversified. So two of those major groups, one representing global equities, the other representing US equities primarily in a diversified manner, showing that international has been the improvement, where you've seen that improvement and almost gain on a relative basis. So again, adding further evidence that we can't continue to really ignore international equities at this point. It's becoming more of the conversation. It's almost like when we talked about commodities last year, it was hard to convince ourselves to think, is this really happening? But, we saw what happened with commodities. We don't have a reason not to believe at this time that we might see the same amount of international equities, at least for the moment.
Yeah.
And because of that, I mean, you have to pay attention to what funds you might be taking exposure to. And this is where sort of sparks some of the conversation is looking at something like ACWI, which says it's a global fund, versus ACWX, which is going to be ex-US. So, looking at those two charts right now, both have given consecutive buy signals, both have rallied pretty notably here recently. But when you look at ACWX for that non-US piece, you've seen that it's able to rally above prior resistance. It's now trading at a level you haven't seen since April of last year. And additionally, you've seen ACWX move back into a column of X's on its market RS chart. So showing that on a relative basis, the fund is improving against the S&P equal weight here recently. And it's the first time since 2018 that chart has been back in a column of X's. So not only are we seeing sort of more near-term things that say, okay, international is really starting to prove itself, but now we're starting to get some of those more intermediate to long-term things, such as, all global and international diversified moving so close to US equity diversified, even seeing this ACWX move back into a column of X's against the S&P equal weight. It's been some years since we've talked about those. So Well, we'll see if they can continue to show that follow through. We sort of ride with international equities right now.
Yeah, and I think part of that too, David. I mean, you said kind of beating that horse on that front. That's because we haven't been able to really talk about it for what almost 20 years at this point. I mean, it's been what 15, 20 years since we've seen some of these international readings, or we've seen international equities ranking ahead of the domestic equity representatives. I mean, even like on that group scores comparison, I mean, you've seen international move ahead of that, or the broader global international diversified move ahead of the U.S. equity diversified over the past 15 years, but it hasn't been able to stay there. And so I think that's going to be the real important thing to keep in mind is that when we're looking at these scores have certainly happened. We've seen some of these changes happen from a scoring perspective, haven't seen as many changes from an RS perspective. And that's giving us a little bit of credence to look at, okay, this is definitely something that we want to keep an eye on, because when we haven't been able to talk about it for so long, it's probably pretty important that it's happening again. So, yeah, I know that there is, hopefully we'll be able to continue talking about international equities over the course of the next couple of weeks. So hopefully people aren't getting too sick and tired of it, and we'll continue to be able to discuss it there. But as with all the other movement, there's been a lot of other movement that we've seen going on. I mean, we don't have time to dive in all the cryptocurrency movement and stuff over the course of the past week or so. We'll devote a podcast in the near future to that. So,
might take us a few hours, but we'll get it done.
Exactly. We'll tune in for a special weekend special, so David and I can really hammer that out. But with that, I think that wraps up most of what we were looking to kind of touch on this afternoon. So thank you, David, for hopping on here. Let me join you here, and thank you very much thank you very much for everyone tuning in this week, and we look forward to having you back next week.